Welcome back to the deep dive. Today we're really digging into some specific numbers from the Nifty Y50. This is from last Friday, May 2nd, 2025.
That's right. We've got the closing data points right here.
Yep. Nifty Y spot closed at 24,241. The futures were just slightly higher, 24,243.
And then we have max pain sitting at 24,350.
Right. Also, the IVP, implied volatility percentile, was 60.49. And a PCR put-call ratio of 0.64.
And this is all heading into the May 8th expiry.
Exactly. So our mission today, if you will, is to unpack this. What's this data telling us about market sentiment potential moves, without getting lost in the weeds?
Precisely. Like, what's the story here as we look towards that May 8th date? Let's start maybe with the spot and futures prices.
Okay, 24,241 and 24,243. That's only a 2-point difference. Pretty small premium on the futures.
It is small, yeah. But that little positive difference, that positive basis, what do we make of that?
What's your read? Mild optimism?
It often suggests exactly that, a little bit of bullishness. Or, it could just be reflecting the cost of carry, basically, what it costs to hold that futures contract until expiry.
Kind of like interest.
Sort of, yeah. Historically, a small positive basis like this, well, it sometimes hints at a slight upward tendency, especially closer to the expiry date, but you always need more context.
Okay, so a hint of optimism maybe. Now, moving on, you mentioned max pain at 24,350. That's quite a bit higher than where we were.
It is. Max pain is this interesting concept. Think of it as a potential gravity point for the index as expiry gets closer.
Gravity point.
Yeah, it's the price level where most options contracts, both puts and calls, would expire worthless. So it causes the maximum financial pain for option buyers.
Okay. So the market might drift towards that.
Sometimes, yes. The theory is that option sellers, who are often the bigger players, might have an interest in seeing the index finish near that level. In fact, it's sitting above the current price suggests, well, a potential path upwards towards May 8th.
But it's not guaranteed, right?
Oh, absolutely not. It's a theoretical level, and big market moves or news can easily push the index away from it. It's just one piece of the puzzle.
Got it. Now, let's talk sentiment directly. That put-call ratio, the PCR, was 0.64. How do we interpret that?
Well, a PCR below 1, like this 0.64, is generally seen as bullish.
Meaning?
It means more call options were traded compared to put options. Simply put, more bets were placed on the market going up.
Okay, so that aligns with the slightly positive futures premium we saw earlier?
It does. It reinforces that picture of perhaps mild underlying optimism among traders at that point.
But then there's the implied volatility percentile, IVP, at 60.49. That sounds kind of high. 60% seems significant.
It is relatively high, yeah. An IVP of 60.49 tells you that the market's expectation of future price swings was higher than it has been roughly 60% of the time over the past year.
So people were expecting things to be a bit jumpy.
Exactly. It signals anticipation of more volatility, more price movement than usual. This could be due to, well, anything really: upcoming economic news, global events, just general uncertainty.
And what does that mean practically?
It means that while some indicators might look bullish, the market itself is pricing in the possibility of sharp moves, potentially in either direction. It also means option premiums were likely higher.
Right, higher premiums for selling options, but maybe more risk too.
Precisely. Selling options might look attractive with high IV, but a sudden big move against you could hurt.
Okay, so let's try and tie this all together. We've got the futures slightly up, a bullish PCR that suggests optimism. But we also have max pain higher up, suggesting a possible target, and this high IVP suggesting, well, turbulence.
It's a mix, isn't it? So for you watching the market, what does this potentially mean heading towards May 8th?
Yeah, what's the practical implication?
Well, that gap up to the max pain level at 24,350, you could see that as a potential magnet, like we discussed. The bullish PCR might encourage some traders to bet on that upward move.
But there's always a but, isn't there?
But yes, that high IVP is the big flashing yellow light. It warns that sharp, unexpected reversals are definitely on the table. So it's not a clear all systems go for the bulls.
So caution is needed.
Definitely. It's a picture of cautious optimism, maybe, but with a strong undercurrent of potential volatility. Risk management becomes really key in this kind of environment.
Okay, so summing it up. Friday's data suggested a market maybe leaning a bit bullish, based on PCR and the futures premium, but it was also bracing for potentially bigger swings, shown by the IVP. And that 24,350 max pain level is, well, it's out there as a possible target for the May 8th expiry.
That captures it pretty well. Cautiously bullish, but be ready for bumps in the road.
Right. So maybe a final thought for you to consider. How might this tension between the mild bullish tilt and the high expected volatility play out? What kind of external event or news, maybe something completely unexpected, could either fuel that volatility or perhaps really pull the market decisively towards that max pain level in the next few days? Something to keep in mind.